Hey guys, hello and welcome to another West Side Meetup virtual edition hosted by Jasmine and CJ Callio of WNN Properties. The purpose of this meetup is for real estate investors, new and experienced, to just grow and learn and of course, network with each other. My name is Jin, and just like many of you guys, I'm just another person investing in real estate. As a matter of fact, CJ, Jasmine, and I just completed a BRRRR over in Kansas City, Missouri. Thanks, guys. But enough about me. Before I introduce our guest speaker for tonight, I just wanted to remind everyone that this event is being recorded. Please remember to mute your mics while the guest speaker is speaking, and then you can post all your questions and comments over in the chat box off to the right. We will answer your questions at the end during the Q&A session. Tonight's guest speaker is a doozy. About 2 years ago, I had the pleasure of hanging out with him for about a day and a half, and I got the inside look of what a full-time house flipper's life was really like. And this guy is a house flipping powerhouse, pun intended. And given enough time, he probably would be able to flip houses all over the nation. And that's kind of what he did when he and his partner started their own hard money lending company called Keco Capital. So now he has his fingers in all different kinds of real estate investment opportunities all across the nation. And so with that, let's introduce tonight's guest, Cory.
Hey guys, thanks Jen. Thank you Jasmine and CJ for having me on. It's great to see everybody. I see a lot of familiar faces too, and it was great seeing some of you last week, right? That was awesome. Well needed. Is that what it is? Yeah, for me. You know, I miss the face-to-face networking and stuff. So thanks again for having me on this week. And hopefully, again, I'll give some value to all of you tonight. As Jin said, me and my partner, Keco, we flip houses here in Hawaii, Seattle, and we had a project in Las Vegas, which we sold last month. And from there, we've also kind of vertically integrated our company to where we now have ownership in a real estate brokerage in Seattle, a construction company, property management company, and our investment fund. So today, I kind of wanted to talk about more about financing for equity deals. You know, so short-term deals, maybe buy, fix, sell, so fix and flip. And even some of this pertains to the BRRRR strategy, right? Because the way you kind of finance a BRRRR deal is very similar on the front end as if you were going to flip a house, right? So talk about the financing and the top strategies that we use to basically fund all of our deals without little to no money out of our own pocket. And, you know, we're playing in high price point markets like Hawaii and you know, the greater Seattle market. So it's very high price points, strong equity markets. And, you know, even though with the high price points, you know, we're able to do these deals with, you know, none of our own money in these projects. So Jen or CJ, I don't know if do you guys want me to get started in the presentation or? Awesome, cool. All right. Oh, and by the way, I'm in the middle of moving, so there's a lot going on around me, and I apologize if there's some background noise. Apparently, a bunch of birds like to kind of cruise here right before nighttime, so I'm sorry if there's a lot of background noise. All right, I'm going to share my screen. All right, here we go. This is a picture of me. Okay, so financing your flip or your fix and flip project, typically we utilize hard money, private money, and DEBTQUITY. And I have JV partnerships in here, but I'm kind of going to glance over that. I'll talk about it right now, actually. JV partnerships are kind of when you can partner with someone or the seller of the property. So sometimes, you'll go into a partnership with the seller where you don't have to come up with the money to purchase the property. Instead, you're going to partner with them, right? So with a JV partnership, it doesn't come along too often, but I kind of want to just glance over it today before we dive in, because sometimes you can structure a deal with a JV partnership with a homeowner, and basically you would bring the funds in to renovate or reposition the property, and then when the asset's sold on the back end, you divide the profits based upon what you agreed your equity splits would be between you and now your JV partner, who is the seller, who was the seller. Okay. So if you guys have any questions about JV partnerships, you can always throw it in the chat or send it. I don't know how, Jasmine, you guys kind of collect information, but if there's any questions, I'll be happy to answer them about JV partnerships. Okay, so before we talk about financing, I always think it's important to go over the basic terminology, right? LTC, which is loan to cost, and LTV, which is loan to value. So loan to cost in kind of like the bridge loan space, we call it. So bridge loan meaning a short-term loan, so like a fix and flip loan. LTC usually pertains to the purchase price. When loan to cost usually is the entire cost needed for the project, that's what LTC usually is supposed to mean. But the industry uses LTC as LTPP, so loan to purchase price. That's what it actually should be called. But in the kind of hard money space for bridge loans, we refer to it as LTC. So there's loan to cost and loan to value. Understanding those acronyms, and interest rate, of course, points. So when you're getting a mortgage, you want to know what interest rate you're going to be paying and what's the terms on that, right? Is it interest only? Is it amortized, right? So understanding basic terminology with interest rate and points is very important, because that's your cost, right? That's your cost for financing. So there's also sometimes when you're dealing with a private lender or a hard money lender who's kind of coming from the finance world, they'll use what's called basis points. So basis points are basically fractions or percentages of a point, right? So 1 point is 1%. 1 basis point is 1/100th of a percent, right? And it's also referred to as BIPs, just in case one of your loan officers or brokers is talking about basis points or BIPs. They're referring to a percentage of a point. So other terminology that you should know is what is full recourse and non-recourse. So full recourse basically means you're personally liable. Non-recourse means you're not personally liable, right? So in non-recourse loans, the only recourse that the lender has is the asset and not your personal assets. Okay. So and full recourse means that you're basically personally guaranteeing the loan. Bad boy recourse, sometimes this clause is in there on a non-recourse loan. And basically bad boy recourse means that it's a non-recourse loan, but if there's anything that's found to be like fraudulent that has been done, then that note can convert into a full recourse note or full recourse loan, okay? Interest reserve, this is very common, especially nowadays, post-COVID. And interest reserve basically means setting aside a set of interest, a certain amount of months worth of interest payments to the lender, setting that aside so the lender knows that there's money reserved for the debt service every month on that loan, okay? So there's also Dutch and non-Dutch interest. So this comes into play whenever there's a construction holdback. So let's say you're going into a fix and flip project and your budget's 100,000, okay? If it's a non-Dutch loan, if you're paying non-Dutch interest, that means you're not going to pay you're not going to pay interest on the $100,000 holdback that's in a separate account. Okay, they're not going to pay interest on that construction holdback until you start to draw from it, right? So let's say you're halfway through the project, you did 2 draws, of 25 each. So you use 50,000 of your $100,000 budget, right? As soon as you draw for that 50,000, you're going to be paying interest on that 50,000, including the principal balance, right? So it gets added to the principal balance, okay? So Dutch interest is the opposite, basically meaning that whatever your construction holdback is, if it's $100,000 and you're paying 10% interest on it, then you're going to be paying 10% interest on the $100,000 from day one, whether you drew the money or not. Okay, and pari passu is basically shared. So a lot of times we finance our deals with hard money and private money. I'd say majority of the times that's what we do. That's what the financial stack looks like on a project that we typically go into. And our gap funding, what we call it, so basically our private money that comes in behind hard money, takes a second position lien pari passu, meaning shared. So sometimes you may have to put 2 private lenders in second position, right? So they can share second position. I would rather do that than do third position, fourth position, and so on, right? Okay, when negotiating for hard money, you basically want to ask certain questions. And with these questions too, you can also use it to negotiate with your lender. And what some of the questions you want to ask is, what is their max LTV, right? What is their interest rate point? Now, they won't be able to tell you that confidently, like right off the bat, because first they need to find out how strong are you as a borrower, and also how strong is the deal, right? And is the deal feasible, and is your experience as kind of the sponsor, right, feasible to be aggressive on their loan, right? So they're basically have to underwrite you to give you solid interest and points. But you can always ask a new lender or prospective lender roughly how much where does the range go, right? Based on experience. So you want to find that out. What's the range on the interest rate and points? And do they charge Dutch interest or non-Dutch interest? And most of the time, it's non-Dutch interest is kind of the most popular out there right now that I see. But I have been seeing Dutch interest, and we've had to do Dutch interest on some loans since COVID. But Dutch interest doesn't mean it's necessarily bad. If you have a big construction budget, like $500,000, then that could, if you're paying Dutch interest on that, then that could sting a little bit, But if you're at like 100,000, then it shouldn't be too bad. And having a lender that does Dutch interest, it usually means that they could be a direct lender. Okay, so that means that the money that they have, they're holding on to. They're actually holding on to the cash. So they have costs for that, right? If they're the direct lender. So that's why they have to charge you Dutch interest and interest on the construction holdback from day one. So, but that also means that they are quicker on the draw, typically. So if you're paying Dutch interest, you may have to pay a little extra, right? Because you're not using that money, but you're still paying interest on it from day one. But typically Dutch interest lenders are faster with the draw process, right? And that makes a big difference in keeping the momentum of a project, especially a fix and flip project. So, what type of recourse is another question, right? Is it full recourse, non-recourse, or bad boy recourse, right? You want to know that. And then does the draw process look like? And that's important because you want to know how you're going to be getting getting your funds back when you're doing a construction draw, when you're filing for an inspection to get your construction draw funds back, okay? Because you want to know that process. You want to know if they are using a third-party fund control company or are they doing the draws in-house. And if they're doing the draws in-house, it's typically faster. They can kind of just look at, the report from the inspector and kind of just wire you the money, so. Okay, so that was kind of a real brief overview of hard money. And hard money we use to basically fund maybe like anywhere from 75 to 85% of the costs on the project. So even though hard money will fund majority of every deal at a high interest rate, that's not enough to get the deal funded, right? So we want to be able to find deals and fund deals. We're talking about funding the deal, and we can get hard money. We can apply for a hard money loan, and most hard money lenders are heavy on the asset-based side. So they usually look at the asset and they judge their risk for doing the deal, right? But recently, it has been a little mix of both. So most hard money lenders want to underwrite the asset, the deal, and also underwrite the borrower too, especially in these times since COVID. So, and the reason is because a lot of these notes, these hard money loans that get done, typically they are resold. So they're sold back to Wall Street. And in order for Wall Street to buy these, to have these notes securitized and bought on the market, they have to meet certain regulations and certain guidelines. So that's why nowadays hard money lenders have to screen the borrower as well. Okay, so hard money will fund the majority of your costs, but what we do is we raise private capital, from private money lenders. We pay them high interest rates, basically to fill the gap. So we're gonna raise the gap funding using private money. Okay, so that way we have hard money in first position, and then we're gonna bring in gap funding with our private lenders in second position. Okay, so that we don't have to use our personal funds to do a deal, right? I got a quick question. Maybe Jasmine, you can answer me this. I'm sharing my screen, but I also have my the profiles up. Can you guys see that, or do you see the full screen?
We see the full screen.
Okay, thanks. Okay. Okay, so private money, we use private money to fill the gap in our projects, right? Private money typically has no monthly payments. They are paid a balloon payment plus their accrued interest on the back when you flip and resell the property. They're typically non-recourse. And right now, the market is kind of showing anywhere from 10 to 12% interest APR, okay? Typically, there's no points as well, and they take a second position mortgage, pari passu, right? Like we talked about earlier. So if you look at the numbers kind of on the right-hand side, this is just an example, and this is a real deal that we had. So this one, we were getting 90% from hard money because we only have to put down 10%, right? So you can already see what the purchase price was, right? 375. So we have to put up 10%. So that 10% that hard money won't cover, we have to bring to the table as gap funding, which we use private money lenders to invest with us in second position behind the hard money loan to fund the deal 100%. Now, this deal, we have to raise the 10% down, right? So the 37.5. We also have to raise in closing costs. This is on the front end. So this includes points, fees to escrow and title, maybe even some doc fees and underwriting fees from the lender, whatever type of surveys that you may have to cover. Anything on the front end is your closing costs up front. Now, the reason why this number is kind of big on this deal is because sometimes when we have enough room on the deal, we'll take a little bit of, I guess, in advance. We call it an advance. We should call it an acquisition fee to ourselves, but we would take an acquisition fee up front on a project. Because typically, if you're flipping houses, you typically don't get paid to the end of the project, which might not be for 6 months or so, right? So if the deal can support it, we will take, you know, whatever we feel that we can without putting the deal at risk, right? We will take that up front as an acquisition fee, but my CPA told me not to call it an acquisition fee because then you have to pay self-employment tax on that money too. So she said, call it in advance. So if it's in advance, then it falls under capital gains, right? So just a tip on that, but double check with your CPA because you know, that saved me actually a lot of money. So let's see, we got to raise the 10% down, the closing costs on the front, which may include your wholesale fee, right? If you're buying it from a wholesaler, it could include your wholesale fee or acquisition fee or advance fee to yourself. You can take that up front, but you got to raise that in the private capital as well. The loan payments here, this is your interest reserve. So I always raise the interest reserve for the entire length of the project. Okay, so if I think I'm going to be in this deal for 6 months, I'm going to raise 6 months worth of interest payments up front from day one. The reason why you want to do that is because the number one thing that has to get done is pay the mortgage, because the typically hard money, they'll wait like maybe 30 days before the servicer starts to come knocking and close on, you know, start the foreclosure process, right? So these are business purpose only loans, and they work just as strict as conventional nowadays. So if there's a late payment or something, then you may have to be dealing with your loan servicer to make sure that you know, you get caught up. But we want to raise that up front. So sometimes, you know, because for us, you know, I own Keco Capital and we do a lot of loans. And sometimes we have new borrowers that are asking like, how come, you know, can I only put up 3 months worth of interest reserve? And you know, for us, it's a really black and white line. Sometimes we can, you know, we can't move. We can't help on that in that area. But what I'm thinking is, because I'm also a borrower, I'm thinking if you're doing it the right way, you should have the money raised up front anyways. You know, so even if we ask for 12 months worth of interest reserve for the whole length of the project, you should have that 12 anyways, the 12 months, right? So that's what I just suggest to you guys. If you guys are doing fix and flip deals, is make sure to either bring in your own money to finance, you know, the entire length of the project's interest reserve, or if you're raising capital with private money like we do, then to make sure that you raise enough to cover the interest reserve for the length of the project, because everything can kind of snowball if you don't have enough money to service the debt to the hard money lender. Okay. Now, the other 2 items that we need to add to the gap funding is we have to raise for the miscellaneous holding costs. Now, this is more for like electric bill, water bill, insurance, taxes, anything that's, you know, the miscellaneous holding costs. You want to raise that as well into the gap for the full length of the project. Now, construction in arrears. So this is based on your budget. Okay, so again, if we have $100,000 budget, then we don't, the lender doesn't give you $100,000 up front, right? Because it'll be too risky for them. They want to kind of do it in tranches, so it mitigates the risk, right? So if a lender is paying you 100% of your budget, and your budget is $100,000, then they've committed to paying $100,000 for you to renovate the property. But they're not going to give it all to you at once up front. And in fact, they're not going to give you anything up front. If it's paid in arrears, you have to put in the first tranche of money, right? So let's say you want to do 4 draws. That means you'll be doing 4 draws of $25,000, right? If you have enough money in your gap funding, perhaps you can do 3 draws, right? And that is, I don't know what that is, 33,000 something. So basically, you don't have to raise the entire budget here, but you'll have to raise a fraction of it, right? And I would recommend not going higher than 6 to 8 draws. Obviously, the more draws you do, the lower amount you're going to have to come out of pocket up front. But again, if you're doing, every time you do a draw, it takes time, right? So every time you do a draw, it's a sensitive point in the project where that you may lose momentum if the draw process takes a little long, right? So, so all of these items here gives us this total, and this is tells me how much we're going to have to need to raise in private capital in order to do this deal without any of our own money in, right? Okay, so basically, when you're raising capital, because a lot of us, you know, to do what we do, we have to leverage other people's money, right? Even if you had a lot of money, like we close loans for some big developers too, and they have the balance sheets, you know, they have the financials to fund the entire project themselves. They still leverage, you know, so, and these are guys that don't need to really come to us, you know, for financing, but they do, you know, and they still want, you know, bridge loans or commercial loans, residential long-term rental loans, and they have the financials, but they still leverage, right? So, but for us, since what we do is we find deals and we fund deals, today we're talking about funding deals, right? So how do you fund the deals? Well, if it's a short-term equity deal, like we're talking about today, like a fix and flip deal, we can use hard money and private money, right? Now, raising private capital is not easy. And so I think it's very important for us as investors or sponsors or general partners or syndicators to understand the two fundamental, like the basic fundamentals of investing, right? And any true investor, it always comes down to, doesn't matter what you're investing in, it comes down to 2 questions, and it's what's my risk and what's my return, right? And is the return worth the risk? So if we always remember that those are the 2 fundamental questions that could, you know, keep us, you know, we can thrive and keep us out of trouble, you know, from getting into deals that maybe we shouldn't be getting into, right? So make sure that you're able to answer these 2 questions. So when you're speaking to a private lender and you're raising capital, make sure you can answer the 2 fundamental questions. And I always say it's best that we're basically, the people who I see who are good at raising money and raising private capital, they don't sell. And I think that's the best way to do it. And that's how I do it, because there's no reason to sell somebody on investing with you as a private lender. Because if you look at what we have to offer, it's a no-brainer, okay? So it's more about educating someone in what the private lending space kind of entails, right? Because for one, if you invest as a private lender, you get a high rate of return, right? And the returns that we offer, the interest rate basically, usually is exponentially higher than the traditional investment vehicles out there that most of the world is familiar with. So when your lender who you're speaking with, prospective lender, is asking themselves, what's my return? Well, your return will be 12%, right? Or 10%. That's, for majority of cases, like that is much higher than what they're typically getting in a, 401k or, IRA, mutual fund, any of that. So we answer question number one, what's my return? Well, your return is exponentially higher than traditional investment vehicles out there. Now, what's my risk? Well, there's always risk in what we do as investors, right? So there's no deal that's 100% risk-free. But with that said, in private lending, right, you typically, especially in asset classes like this, like a single family fix and flip project, we typically give roughly 4 documents, right? So you get your lender gets a promissory note and a mortgage, which basically secures their money against the asset, right? So they get a lien position against the property. So they have collateral in a tangible asset, right? Whereas compared to the stock market, there is no security in the stock market. If the market goes down, there's, you got to kind of hope and pray that it comes back, or, cash out and take your losses. But, if there's no collateral in a tangible asset like real estate. So when they ask themselves, well, what's my risk? Well, of course there's risk, but is it substantially less than most traditional investment vehicles out there? Absolutely. And here's why. You get
yeah, they got somebody coming on their way right now.
So they get collateral in a tangible asset, right? So the other kind of 2 instruments that secure their investment is we always get property insurance and title insurance, right? And so the insurance basically secures the asset to which the investment is collateralized on, okay? So another thing is you typically have direct access to the principals or the sponsor or the syndicator who's kind of in charge, right? Whereas if you put your money in with Bezos over there in Amazon, right? Most likely you don't have Bezos's cell phone number, right? Or you can't, even though you're an investor in his company, you don't have direct access. You don't know where, the company's going. You're not in on those board meetings, right? So, and that's another thing with kind of like with Wall Street is like, we're like, typically the retail investor is the last to know, and I don't like having that disadvantage, right? So for us, or as a private lender, we're direct to the source. So if the project's not going well, or you know who to call, and hopefully have direct access to that person. All right. So again, this is just another slide about raising private capital. I always like to address the two questions, or the 2 concerns, the 2 fundamental concerns of investing before they even have to ask, because we should be educating again, right? So sometimes in sales, we ask them the questions, right? And we use their answers as a way to continue the sales process to closing, right? But this is not selling. I suggest we educate. So when we educate, we take control of the conversation. We tell them what it's about. We address the 2 fundamental concerns about investing before they even have to ask, right? So when you open up the questions, it's not questions about, the 2 fundamental concerns. It's more miscellaneous questions that you have to address, right? So, anyways, one key thing that I've learned from raising private capital, and we've raised millions of dollars in, multiple markets, different states, and it's always the same. And what the key I feel is to be confident in what you have to offer as the sponsor or the lead syndicator. Okay, like be confident because you have a strong investment product to offer that person sitting in front of you who's showing interest in investing with their money with you. So when you take that confidence approach, it changes the dynamic, because really, if they don't understand it and they don't see that this investment opportunity for them is much stronger than what they may be already investing in, then they're just not ready yet. Okay. And I always feel that, not all money is good money. Okay. You want to make sure that the trust goes both ways, because they have to trust you with their money and you have to trust them with your time. Okay. Because sometimes if you bring on a lender who is not sure what he's getting himself into, and he trusts you, but he's still worried about, he doesn't understand it, it's probably best to not take his money, because it's going to cost you in time. Okay. They may be calling you every day, and you don't want to take someone's money who's going to have remorse about it later. Right. And you want to take someone's money who has gratitude for the opportunity that you're giving them, because there aren't many private lending positions open, right? Very, by trustworthy investors. So just know that you have a strong product to offer, and not all money is good money. Okay. Sources of private money is cash savings, obviously, home equity line of credit, so HELOCs, even personal lines of credit, self-directed IRAs, even self-directed 401ks now, and leveraging life insurance policies. That's very powerful as well. So the main thing is, you have to know that when you're raising capital, you have to know that there's money everywhere, right? And all we have to do is educate others on what we do and what we have to offer, because if they are serious about growing their wealth passively, then they'd be very interested in this. And if they understand it, and if you did your job well educating them, they should invest, and they will invest. Okay. So this last strategy is very powerful in my opinion, and we've been using it more and more. We refer to it as DEBTQUITY. And basically, DEBTQUITY is giving a debt position to a private lender that also is tied to equity. Okay, so there's the beauty about DEBTQUITY is that your private lender will get all the securities of being a debt lender, right? So they get the promissory note, they get the mortgage, they get the title insurance, property insurance. So they get all the benefits and the security of being a debt lender with the potential upside of being an equity partner. Okay. Now, basically, there's 3 documents to secure a DEBTQUITY partnership, and that is the promissory note, your second position mortgage, and a partnership agreement, which will detail the equity split that's decided upon. So basically, in a DEBTQUITY deal, the private money lender receives the promised interest rate or agreed upon equity, whichever is greater at the end of the deal, right? And this is mainly for equity deals like fix and flip, short term, okay? So here's an example. Let me move this, there we go. Let's see. So Bob invests $100,000 at 12% interest APR, right? The project is expected to take 8 months and net $100,000 in profit. So based on projections, Bob is expected to make $8,000 with his interest rate. So as a debt lender, Bob is expected to make $8,000 with his interest rate because his $100,000 principal investment at 12% APR basically means that he's getting $1,000 a month in interest. Okay. And if the project is expected to take 8 months, that's $8,000 that Bob is expected to make with his debt position. Okay. Now, to calculate Bob's equity position, we take the $8,000 that he's expected to make as the debt lender, and we divide that by our projected net profits in the deal to calculate his equity. Okay. So we're expected to make $100,000 in this deal. So we take 8,000 divided by the 100,000. Therefore, Bob will receive 12% interest or 8% equity of the net profits, whichever is higher at the end of the deal. Okay, so let's say Bob hit it out of the park. He only took 4 months, okay, to do this deal. And let's say he netted 150,000 instead of 100,000, right? That means Bob as a lender would make his equity profits, right? Because he would either make $4,000 because it took the investor 4 months to do the deal, or he'll make 8% of 150,000, which I believe is 12 grand. I think 8, roughly around there. So now on the flip side, let's say Bob took 12 months, right? And he netted 50 grand, okay? Then he would make 12,000. So his debt position would be worth more. So he would make his $12,000 at the end of the 12 months, right? So whereas making 8% on his equity side of the 50,000 that he actually made. So there's a tipping point, right, between the debt and the equity. And that's why it's a very powerful strategy, because you're still offering a private lender all the securities of being a debt lender, but they have a chance to maybe double, what they're supposed to make on the equity, depending on the success of the project, right? So, and I want my lenders to make good money, right? So if they can have the upside, then great. If the deal can afford a equity position, then that's perfect. Because really it doesn't cost you much, because if you make more and you gotta get it done faster, then everybody makes more money, not just your equity lender, right? So hopefully everybody understands that, but feel free to ask questions. Okay, so leveraging 100%, this is how we stack our financing: hard money, private money, equity, and potential partnerships. There's one thing, just be careful not to over leverage, right? Because leverage and debt can be a double-edged sword, right? It can help you scale very quickly, and it can also sink you, right? So you have to just understand debt. Don't be afraid of it. In fact, look at it as opportunity to help grow your wealth quicker. But always just remember that it's still debt, and that debt needs to get paid. So make sure that you respect it and you're being very conservative with running the numbers on your deals. Plan for the worst case scenario and have multiple exit strategies. So basically that's what my presentation on financing for short-term equity deals like fix and flip, even ground up construction or small single family residential development projects. This financing typically is utilized. So, and this is how we finance pretty much 100% of our deals. It's either with hard money, private money, and equity partnerships. And we've done a couple of JV partnerships, but we haven't done them in a long time. So hopefully everybody understood that. And if you guys have any questions, feel free to put it in the chat or chime in.
Thank you,
guys.
Cory. That was really great. I wanted to start off the questions with the COVID thing. So I noticed a lot of what you were saying was prior to this was required. So what was it like before? What happened? And then what are some things that are different now?
Yeah, I mean, that's a great question. COVID was kind of crazy times for us as in the hard money space. And it's interesting because I'll give you guys a background of how this all works. And basically, I would only say maybe 5 years ago, the investor space, especially the fix and flips space, grew exponentially and very fast. And I think it's because of the fitness house shows on A&E back in the day, right? And then that which led to like HGTV and all these home design shows. So with the spotlight, with the national spotlight on our industry kind of exploded. And I tell this story all the time, but I remember when hard money was like 15% and like 3 to 4 points like minimum. That was if you're an experienced investor. It was very expensive. And I remember that we didn't have to necessarily design a house when we're doing a house flip because, HGTV wasn't on air yet. But ever since HGTV and all these house flipping shows and these training companies, now we kind of actually got to design the house, so which is good too. The good thing about that is those shows and the national spotlight on our industry grew our industry so big to where Wall Street, took a notice and they saw opportunity. So Wall Street money started to flow into the market, into the finance space, into the hard money space, which basically dropped interest rates for hard money significantly and increased leverage significantly since about 5 years ago or so, maybe 5 or 6 years ago. And so it was a good thing because the cost got cheaper for us investors, even though now we do have to kind of make sure we basically design the house and make it look like HGTV, So now that Wall Street's in the space, the space has changed. A lot of these notes, when they get closed, when your hard money lender closes the deal, they typically sell the note immediately to Wall Street, okay? And there's big note buyers on Wall Street that will buy a bunch of these hard money loans, securitize them, and then sell them back to Wall Street. So the money comes from Wall Street and then it goes back to Wall Street, right? So that's kind of like what we see here. And the important thing to know about that is when COVID happened, basically in late March, I think, or mid to late March, when the stock market took a dump, right? It was free fall. I think they had to pause the market like 4 times or something. A lot of the hard money space dried up. The liquidity dried up immediately. There's no money. Okay, so we had 4 loans on the table, and we basically, like, one of them even signed, and the other 3 they were about to sign like in a couple of days. And then we were told that, we can't fund. And I was like, what do you mean we can't fund? We've committed already. One of them even signed the documents. They signed the mortgage and everything. We have to fund. And they said, there's no money. I was like, how can there be no money? These are big companies that work right on Wall Street, and they're massive institutions, and they have unlimited capital. So how come all of a sudden there's no capital, right? And what happened was, and I've been learning this along the way too, because we're a little new in the hard money space, is the note buyers on Wall Street stopped buying immediately. So they stopped buying notes from these, hard money lenders, and these institutions that were funding us, because we act as correspondent lenders. So we're not direct lenders yet, although we will be very soon. We're correspondent lenders. So we have partnerships with multiple institutions that basically fund us at the table, or they fund a portion of the loan at the table and we come in with the rest. So that's why we don't need the capital. We bring the deal flow, because some of these institutions are very large where they don't have loan officers to go out and source deals individually, right? They rather work with correspondent funds like ours to bring them the deals. Although, you know, some of these bigger institutions have been doing that lately. Anyways, so these large institutions, they typically have big lines of credits with these big banks, you know, internationally known banks. Some of, like most of us might have our money in some of them, you know, like JP Morgan, Goldman Sachs. So they get big lines of warehouse lines of credit that they pull on these institutions. They pull on these lines to close the deal at the table. Okay. And then once they close the loan, they take the note and they sell it to the buyers on Wall Street. So what happened was in March, after COVID, the buyers stopped buying the notes immediately. So there's no liquidity anymore in the market for these institutions. But not only that, the big banks started doing margin calls on their lines. So they started calling their lines, their warehouse lines of credits due immediately. So not only did these institutions they're not able to sell the notes to get their money back to pay down the line, but now the lines are calling their line due immediately. So they got stuck in the middle, right? So they just used their money to close the note. They can't sell it to get their liquidity back, their money back. And now the banks are calling the money due and they have no money. It's out on the loan, right? So a lot of these big institutions went belly up like overnight. And it was a bloodbath on the finance side. And the fix and flip investor side, you know, they don't know this, that, you know, what's going on in the background, right? So many people don't know this because, but I have the inside on the hard money space, right? Because those are all my partners. Some of my partners, they're no longer in the business anymore. They got stuck. So that was a big lesson for me. Make sure you don't over leverage, right? So plan for the worst because the worst can happen. So anyways, for us, we have to, being a correspondent lender, so there's plus and minuses to being a direct lender and a correspondent lender. Being a direct lender is like, I'm in charge. You know, if I say I want to do that loan, but it doesn't fit quite in our credit box, I'll say, do the loan, like send the money. You know, I trust CJ and Jasmine. Like I've seen them, you know, perform multiple times, like send them the money. But since we're not the direct lender, we're a correspondent lender, we fund deals through other institutions. We have to stay in their credit box, but we don't have to stay with one institution. We can pivot and work with whoever has the best credit box for our client's deal is what we, you know, so we're flexible, we're mobile. Whereas these direct lenders are not so much that, right? So when this happened, our partners in New York, they were, I mean, the Friday before the market, as the market was crashing, they said, don't worry, we're good. You know, this is going to be awesome for us because like now there's going to be so much deals out there that we can fund, you know. Come Monday, I get the call saying, oh, you know what? We can't fund. We have to clear our balance sheet and just sit this out. I was like, so I was not sure what to do because we have 4 loans at the signing table, right? And it was not going to look good. One of them was Brandon Turner's loan too. And that would not look good. And Brandon's seller was threatening to sue him if he didn't close. I'm like, oh no, this is turning into a nightmare. So, but anyways, we were able to pivot. We moved with, we signed a deal, like probably the fastest one we've ever done with a new partner, and they were able to close. And they knew who Brandon was, you know, so they're like, oh, we'll close that deal. So I was like, oh, thank you guys so much. So we ended up closing 3 of the 4. And the only reason why the other one didn't close is because the investor got spooked, rightfully so. You know, I honestly thought all of them were going to get spooked and not want to do the deal, but we ended up closing 3 of the 4. So that was a crazy time. And that's the COVID story that I'll probably be telling, you know, to the day I retire.
That was a really great story. Thank you. We are at the end of the hour. I would like to hand this off to CJ to close, and we'll finish up the questions if that's all right with you, Cory, after we're officially done with the meetup.
Sure.
Great. Thanks. CJ?
Okay, thank you, Cory. Thank you for joining us and flooding us with all that hard money information and loans, things that I'm not fond of, but you expressed and taught us very well. So thank you for that. Everybody that was on this call, we appreciate you jumping on and joining us. This is the Westside Meetup that we hold every last Wednesday of every month. If you're not already on our email list, please get a hold of Jasmine via chat. We would love to add you. We do not spam. We send out a reminder the Wednesday prior and then the day of with the topic, the time, the location, and the speaker. With all these restrictions in Hawaii being lifted, we're hoping next month we will be able to lock down a space and be able to meet in person once again. So fingers crossed. If you know anybody in politics, please spam them so we can have our in-person meetup again. With that being said, October's topic, we already know, it's very fitting, Halloween. Although 2020 feels like Halloween every month, every day, every hour, we're gonna do horror stories. We have a panel of investors that are willing to share their nightmarish of experiences in whatever investing venture they took on. So please join us the last Wednesday of October for Halloween horror stories and investing. Outside of that, we want to respect everybody's time. We will now officially end this meeting and go straight into Q&A. So if you're wanting to, please stay on and network. Cory's going to be on as long as he can. Me and Jasmine will stay on until everybody is complete.